The key features section is a summary of the product particularities highlighting the risk factors. Risk factors? Yes, for example, if you live too long, the shoes may need repairing. On the other hand, if you die before you wear them out, I'm afraid there'll be no refund even if they don't fit another member of the family. So just to recap, you've got my card, letter of introduction, your statutory notice, product particulars, key features, quotation, and risk analysis. Now, please take a seat while we await the letter from my head office advising you that I do in fact work for this company. By the way, there is a cooling off period. You can still return the shoes within 30 days and receive a full refund if you don't like them for any reason. Incidentally, how are you paying? Cash? Well, sir, we have to consider the possibility of money laundering. So, may I see your original driver's license or valid passport to prove your identity so I can be sure that you are genuine and not mixed up in some sort of unsavory financial arrangement? And one last thing, sir. Do you or any of your friends, do you have any friends who require shoes? If so, would you mind calling them on my behalf and secure their permission for me to contact them? I mean, that is obviously tongue-in-cheek, but I think we should send that to every regulator because that's the silliness of that's what we've evolved to. Words like, and Mr. Geller referred to this, simplified prospectus is an oxymoron. I just grabbed the first one out of the supply room. 50 pages, you've all seen this, sorry, I lied, 47 pages that describe the nuances of the product generically, and that's the simplified version. This is bogus, but if we don't hand it out, we get our wrist slapped. Nobody's ever read it, nobody understands it, we're killing trees, but I can go to jail if I don't hand it out. That's a dumb rule. Another one I love is KYC. They run around, they're righteous, we have these KYC requirements. KYC is bullshit. Sorry, I'm not supposed to say that. KYC is somewhat misguided. KYC is done at the account level. So I have a client, a lady with an ultra-conservative risk tolerance. She has this much money. We've taken 5% of her portfolio and put it into something that has an element of risk that is outside the KYC for this big thing. For this account, her risk tolerance has to be higher. But what's the impact of high risk tolerance on the total portfolio for 5% of the portfolio? It's illogical to do this at the account level when you're dealing with people's overall financial affairs. So what have we got? A ridiculous form that's designed, we fill it in, I don't. We fill it in to appease the regulator. It does not help the customer. The customer doesn't understand what it's for. It's just another piece on the pie. You may not like this one. I have great difficulty understanding how you can sell variable products without being trained on variable markets. There's a lot of things wrong in the United States in terms of their regulatory system, but I don't understand why we don't have a parallel arrangement to their Series 6 requirement. If you sell variable products, why do you not have to have some specific training that says you know your way around the variable product market? It's a ridiculous inconsistency. How in God's name does that serve the consumer, where depending on which door you walk into, you can get a different product solution, purportedly different product solution, but it's exactly the same product, it's just got a different wrapper around it. That's baloney. Too much of the holding out stuff that we're faced with today is all about who can we blame if something goes wrong. The system is being set up so that we know who to point the finger to. We need to work cooperatively to change that. I was interested in Larry Ritchie's comments this morning because I think one of the confusions is there's some really bright, well-intentioned people, and they're coming at it from a capital market regulation perspective, which needs to happen, and that's why we did so well in the last few years. We have great regulation of our capital markets. The bottom of their list, when they're running out of time and money, is distribution. So the wrong people are trying to regulate distribution. I don't understand why the people in those positions don't come at it from a capital market perspective here, get a group that comes at it from a distribution perspective there, and they have to meet somewhere in the middle. I don't understand their world any more than they understand mine. So again, we need to continue to push for the dialogue. We need to be there. This is a blatant commercial, and I'm preaching to the choir. There is no way one advisor is going to be able to advance this discussion when you see the complexity of the issues and the resources that all the players except us have to bring to the discussion. We need to be unified as a profession so that we get a voice at the table, represent our customers. I truly believe that we are interested in that, and that's probably the best voice that the consumer is going to have in the dialogue. So now's the time for us to pull together. I'm so glad that you're all here today, and thanks for your time.